Yes, good afternoon, good morning, and good evening, and welcome to the practice webinar of the Impact Weighted Accounts Framework, organized by the Impact Economy Foundation. In about the coming hour, we'll delve into the Impact Weighted Accounts Framework and how it helps organizations with measuring, reporting, and steering on impact. And of course, we have a bunch of practical examples of how organizations have used it, how it has created value for organizations, and how the impact weighted accounts framework has also helped to create value for society. And I'm excited to see that we're with such a diversity of professionals here today. My name is Werner Schouten. I'm the director of the Impact Economy Foundation. And at the Impact Economy Foundation, as you may guess from the name, we're building the impact economy. And the impact economy is an economy in which work, innovation, and entrepreneurship truly contributes to the creation of broad prosperity for all. We aim to create an economy in which businesses use all of their resources to resolve our societal issues rather than creating them. We aim to have businesses that take societal value creation as the core of their business model rather than it being an add-on or a program in the organization. And at the Impact Economy Foundation, we're convinced that if we want to make the creation of societal value the core of an organization, the contribution to the SDGs, the core of an organization, we see it as imperative that organizations not only in detail report and steer on short-term financial value created for investors, but that they also report and steer on the impact they have on society, on the impact they have on all stakeholders, and on human capital, social capital, and natural capital across their complete value chain. Because if we can quantify those impacts and even monetize those impacts, we can truly do integrated decision making. We can make investment decisions based on the impact an investment option has on society. We can develop products with the aim of optimizing their value to society. And the impact weighted accounts framework aims to achieve this and aims to help organizations in achieving this. And the Impact Economy Foundation has developed this framework together with the Harvard Business School, with the Erasmus University, with the Singapore Management University, and with Impact Institute. And in the coming 60 minutes, you'll hear more about the nuts and bolts of this framework. But now we have, of course, developed this framework. For the next step, we actually need you, because currently we're running the public consultation of the impact weighted accounts framework. We're trying to gather the power of the crowd to find points of improvements in our framework. So after this webinar, after we've told you a lot about measuring impact, valuing impact, and steering on impact, you will receive an email with a link to our public consultation. And we have a set of public consultation questions for you. And some of these questions are technical questions, but we would very much appreciate if you would be willing to respond to this public consultation so that we even can further improve the impact weighted accounts framework that has already been developed by our academic council and by the working group working on the impact weighted accounts framework. Because with your input, we can further improve the transformative power of this framework, and we can ensure that more and more organizations actually start to optimize the value they create for society. Because after we have your input from the public consultation, we will launch the framework and we will roll it out big time in financial sector, in food sector, in the retail sector, in a diversity of sectors, so that an increasing community of organizations actually steers on impact and actually aims at contributing as much as possible to the SDGs, to the Paris Climate Agreement, and to bringing back Earth Overshoot Day, the day on which we've used up all of our resources that we actually only have for 1 year, to bring Earth Overshoot Day back to the 31st of December. That is what we're up for, and that's why I'm so excited to be here with such a big group of professionals from impact, from sustainability, from reporting, from strategy, and whatnot more. Now, with that being said, I'd like to give over the floor to the moderator of this afternoon. He is the program director of the Impact Weighted Accounts Initiative at the Harvard Business School. I'd like to give the floor to Rob Sikowski. Over to you, Rob.
Wonderful. Thank you very much, Werner. Thank you all for joining us. Good morning for those in the Americas, good afternoon for those in Europe, and good evening for those of us joining from APAC. We are really thrilled to be with you today. I will be the moderator and the timekeeper. We have a great panel of practitioners here today who we are going to get to. I would encourage you to use the Q&A button on the bottom of your screen. We will have some of our technical leads helping us put on the webinar today to be sifting through those, aggregating those, and surfacing those to me as I'm asking the questions. Without further ado, to keep the momentum going, I'm thrilled to introduce Werner de Aldertroep. I probably killed the Dutch, I apologize, but Werner is the head of research at the Impact Institute and the lead on the IWAF framework. And he's going to talk a little bit about the principles and a brief explanation of the guidance that we have given there. So, Werner?
Thanks, Rob, and welcome all. And it's a pleasure to be speaking to you. I'll be sharing my screen, and we'll have a brief look at some of the elements of IWAF. So here we start with what I think is the shortest possible summary. So IWAFs, or impact weighted accounts, are a way to make value creation of your organization explicit. So not only the financial value, short-term financial value you create for your shareholders, but also the value you create to your employees, your clients, your governments, and to nature. So they identify your main impact and express their value. And we'll get into a lot more detail what the word impact actually mean. I think that's the biggest key here. Impact weighted accounts can be used to identify your main risks and opportunities. And we have a strong belief that organizations that use IWAS and that understand IWAS, that they are the most ready for the upcoming wave of regulation. My colleague Esther will say more about that in the next presentation. But first, the logic of the impact weighted accounts. And as it says, they are accounts, a bit like financial accounts, and that's where our thinking starts. So I have here a very simplified overview of what I think is the key of financial accounting. And when you think about it, what really matters on your profit and loss statement is the bottom line. You really care if they're showing a profit or a loss. And what a profit basically means, it means financial value creation for the stakeholder group, your shareholders. And I've visualized that here with a dot above the axis, representing a profit. If it were a loss, it would be a dot below the axis. But in the end, this is single dimensional. It's just one impact: profit, financial value creation for your own shareholders. But at the impact weighted accounts framework, we try to think broader, and we try to think, well, are we only creating value for our shareholders? No, we're not. We're also creating value for others. So this is the first step. So we also might create financial value for our employees if we pay decent wages. We are creating value for our governments if we pay our fair share of taxes. Financial institutions might be creating directly financial value for their clients, etc. So that is why the dot above the axis has expanded. Well, of course, it's also in theory possible that you are reducing financial value for some of your stakeholders. For some organizations it is, for others it's not. But just in case, I've shown the possibility with also a dot below the axis. So that's our first train of thought. Let's think beyond the financial. Let's think beyond the sole shareholder. But then secondly, we want to think beyond the financial. And then your impact weighted accounts may be visualized like this. So it's value creation in terms of all forms of capitals. So those are financial capital, basically everything that is money or directly related to money. It's manufactured capital, basically everything you can touch or tangible assets. It's intellectual capital or intangible assets. It's natural capital, everything having to do with the natural world and the environment. And interestingly enough, those are often stocks that are not owned by anyone in particular, but that we all have access to and can use. There is social capital, which is about the social bonds in society and how we function as a society. And there's human capital that has all the capitals directly related to a single person. So our health, our competences, and our well-being. So I think now it's time to have 2 poll questions to all of you. Those of you that work at a organization, a commercial organization, answer them for your own organization. And to all others, think for a bit on your favorite organization or maybe on your least favorite organization and answer the question for those companies. Fernanda, can you give us poll 1? Yes, there it is. And the first poll is, which impacts are you creating in a positive sense? What is the most important positive impact you are creating with your organization? Looking forward to seeing your answers. And I think there we have the results, which is a mixed bag. Quite a few in social capital. I think that's the winner, but also close numbers for intellectual, natural, and financial capital. Interesting. Thanks for voting all. Let's also have a look at your main negative impacts. I think most organizations do produce some negative impacts, albeit unwillingly. And if you look in a very honest way at your own organization, which would be the main negative impacts that are associated with your organization? Voting is up again. And there we see the results. And I think most say in natural capital, a little over half, although also around 20% mentioned financial capital. Thanks for those results. And it already shows that we have a very diverse group of organizations here, but it also shows the importance of thinking in terms of 6 capitals. There's not a capital that we could easily leave out and still have a complete picture. Moving on, what does it actually happen working on impact statements in the philosophy of the impact weighted accounts? It does. Here we have a number of organizations that we and others have worked with. Some of them literally follow IWAF from start to end, others more in the spirit. But we see it's getting increasingly popular. And we also see that there's 2 main applications of impact accounting. On the vertical axis, I've shown an external motivation. So basically you provide accountability by being very transparent to all of your external stakeholders. How are we creating value for you? And maybe are we reducing value for some of them? And on the horizontal axis, there's the alternative use, which is mostly for steering. So you find yourself, what are my positive and negative impacts? And how can I improve my positive ones? And how can I reduce my negative ones? And again, in order to do that in an efficient way, it really helps to measure, because it's often said, what isn't measured can't be managed. And of course, I'm very thrilled today that we have 3 organizations that are presented in this graph, and they'll be telling much more about how they provide accountability and how they are steering. This is where we had planned the third poll question. If you think of your own organization, what would be your preferred focus? Would it be an external one or an internal one, or maybe both? And here we have the results, and yeah, almost 3/4 like both purposes. Happy to see that. And of course, also very interested those that want to manage impact and those that want to provide accountability. Moving on, can we help you make impact-weighted accounts? Yes, we can. And one of the key documents, and one that I really want to bring under the attention today, is this guidance document that we have provided together with a set of more technical documents. It provides the 10 steps in your impact journey. It gives concrete guidance what to do step by step in each of those steps, and it includes an example. And the key figure of that document is this one. It has the 10 steps from getting started to taking action and managing impacts. If you follow these, still not an easy task, but we believe that then you can always go a really long way in making your impact-weighted accounts. To illustrate that, we have included a example in our guidance document. It's a hypothetical example, not to share any, to have the risk of sharing any confidential information. And it's a company that we thought of and we created as Glutelicious, which is a producer of gluten-free bread in Northwest Europe. And they sell their gluten-free bread mostly through retailers. And let's have a look at what their, let's say, their first year impact journey could be like. And of course, we are starting with the first steps of the impact frame. How should they get started, and what are some potential objectives with them? And well, as I said, this is a hypothetical example, but it aligns strongly with the objectives that we typically find in our clients. So Glutelicious wants to understand their value creation. What is really the story behind their value? They want to communicate what they create to various stakeholders, and they also want to use their impact results in a path to sustainable innovation. Of course, there's always a couple of ideas how you can become more sustainable, but if you measure your impact, then you can really manage it in an efficient way. And here we have visualized the main stakeholder groups. So the company itself, their employees, their clients, so the nature or users, beneficiaries of nature, society at large, and the world and the governments in the world. Moving on, the next step is a scope step where you think, well, what impact would I love to focus on? And an important decision that Glutelicious, and again, many of our clients make, is that they like to focus on the full value chain for externalities. You can't say, I'm a sustainable company if you are directly sourcing from suppliers that horribly pollute the environment, or even worse, that don't respect human rights. Those will always come back to you. So we really often say you are just as sustainable as your value chain. And therefore, if you do an impact assessment, includes the full value chain. And then here we see a couple of impacts that they decided to put in scope. Contribution to climate change, very obvious. Well-being of employment. So we see that if you provide meaningful employment to people, beyond just getting a salary, you also provide well-being to your employees, a sense of belonging, a sense of use. The effects on human health. Is this bread part of a healthy diet or an unhealthy diet? And can we quantify that to some degree? The important one is contribution to poverty. Are you contributing to the continued existence of poverty, for instance, by paying your employees too little, or doing business with organizations that pay your employees too little? Or are you providing a solution to poverty by basically allowing underrepresented groups to grow and grow out of poverty. And here we have another impact that is often relevant, occupational health and safety excellence, but in this example, for this specific company, they have arguments why they put it out of scope. Next, what the organization wants to do is they want to measure and they want to get quantitative where they can. And what we find time and time with our clients is that you can do more than you think. If you start thinking, how do I create value? What are the key properties? What can I quantify? Then very often you can make a model. And you see here what we call a calculation tree for the contribution to climate change, but for other impacts, it would be similar looking. Next step, step number 5, valuing impacts. And this is, I think, one of the key elements of IWAF that we choose for consistent monetary valuation, which means that we express all impacts in the same euro or dollar unit. And of course, you don't have to find all those values in literature. IWAF provides the key values for you in their appendices. And as an example, we calculated this true in the example company. They have a effect on climate change of their own operations, which is a negative impact of $3.6 million and a little over $10 million in their value chain. Next step is a very important one. It's on aggregation, because if you have lots of numbers, you can't meaningfully steer on that. So you need to go back to a limited set of numbers that are tangible and that you can work on. And here I want to sort of pre-counter one of the most heard criticism of monetary valuation. And that is, if you monetize your impact, you monetarily value them, you are supporting netting impacts. And you would be open to claims like, yeah, this deforestation here is okay because it leads to employment. And want to be very clear, we don't support such claims, and users of the impact-weighted account framework should never make them. We say you can aggregate numbers, but separately aggregate the goods and the bads, and separately steer on those, and don't say it's okay because the goods are good while the bads are bad. Next step, you compile the impact statements, which can be the integrated profit and loss accounts that we've built together earlier in this presentation. And you end by reporting on your impacts and managing your impacts. And of course, I can tell a lot about how our company does it, but I think it's way more fun to give the floor back to Rob, listen to what Esther has to say on the relation with regulation, and then have the panel, have Manon, Nalini, and Carlos tell them how this actually happens in their companies. Thanks.
Wonderful. Thank you so much, Werner. And one thing I'll just say before I hand it over is that while it might seem like a lot of information, we've really tried to give sort of various documents of IWAF, right, to meet people where they are, right? So I think there's even a document that says if you only have 30 minutes and you have to go into a board meeting, here's what you have to know, right? And it sort of progresses it in a logical way. The other thing, which is a perfect segue to our next speaker, right, is you might recognize a lot of those steps from some of the Capitals Coalition, the natural and social capital and human capital protocols, right? And what IWAF has really done is try to one of the speaker's questions, which I'm about to answer in the Q&A, has really tried to deal in the sort of nitty-gritty of how to manage some of those, especially those latter steps around reporting, right, which is where a lot of the ethical issues can sort of come up. So without further ado, to talk about how IWAF relates to the CSRD and other reporting standards, I'm thrilled to introduce Esther Vitorino, the lead expert sustainability advisor at Van Luschenkempen. So Esther, again, sorry if I got the name of your corporate wrong, but we're thrilled to have you. And Esther is a key author of the IWAF as well.
Thanks so much, really. Thanks so much for the opportunity. Indeed, I work for Van Luschenkempen, which may be familiar to some of the audience on this webinar. Thanks for the opportunity to speak. And I was just thinking, we're a listed company and a primary audience for profit and loss statements, a shareholder. a data user, an asset management firm. So both the listed company and kind of the reporter and the data user hat is something I can put on today. And to be honest, if you're anything like me, you're thinking, wait a minute, I've just been through an entire summer of giving feedback to ISSB and ESRS and CSRD and the Corporate Sustainability Due Diligence Directive. What is this about? Well, this is where I would like to share my views and the thoughts and explain how I think it all fits together. So when you look at the different frameworks that most of us have been using for sustainability reporting so far, let's just focus on ISSB, the forthcoming standards of ISSB, and the European Sustainability Reporting Standards, which are more aligned with the GRI perspective. The fundamental difference is, of course, the ISSB having a bit more of a focus on financial materiality, and the European standards, apologies, my answer is more European focused, hopefully also relevant and interesting to audience from the other parts of the world. But so the European Sustainability Reporting Standards have this kind of double materiality threshold, which means looking at the impact materiality, the relevance of external impacts that the company creates. So there is a natural fit and how IWAF fits into the whole picture. It's basically helping you potentially to report with all the other frameworks. I think the quick explanation that Rainier just provided, showing the 10 steps, is an approach that you can very well apply to your other reporting frameworks, because it's very helpful and straightforward. And if you look at some of the other reporting frameworks, sometimes that step-by-step guidance is actually missing, especially if you're interested in monetizing and valuing impacts. And I'd like to paraphrase what Werner has said at the beginning. Ultimately, we want to see many more companies issue impact-weighted accounts to lead to an integrated decision-making. And an integrated decision-making requires the step of actually valuing impacts and identifying the most meaningful impacts that need to be valued. Also, the 10 steps as presented by Rainier actually fit to any reporting framework, and also to the European Sustainability Reporting Standards, which is the implementation framework for the CSRD, that follows the TCFD's framework in the sense of starting with the strategy, what's your governance, what are your policies, what are your metrics and targets. And so that kind of approach is very well fitting together with the 10 step that we've just heard about. So that's one thing, to look at the CSRD and the SFDR, so to think about the EU regulation that we're looking at. So I've talked a bit briefly about the frameworks, the fit with the different frameworks, and also Rob very wisely mentioned the alignment with the capital protocols and the principles underlying the protocols, and also the principles for assessment underlying the protocols. There's a very clear alignment with that work and the IWAF on the framework side. And on the side of regulations, so SFDR is what the asset managers and financial industry players need to report to, and CSRD is the Corporate Sustainability Reporting Directive, where you also see how, again, as underpinned by the European Sustainability Reporting Standards, the ESRS, the IWAF provides a very clear, a very straightforward methodology to help you on your path to an integrated decision-making. And as Werner also said, to bring overshoot day back. So it's really a framework that doesn't just focus on reporting, that really tries to focus the attention on the real world outcomes and provides a framework to move to that space and focus our decision-making on a holistic approach that has an impact on society and on the environment as well. that's it in a nutshell. There's so much more to say about this, the values of IWAF and how it's been applied. So I think the panel is in the best shape to was positioned to answer that question. So I hope I've also touched upon the CSRD long enough, but there's the follow-up question. I'll be very happy to take it. Thank you.
Yeah, again, everyone, the Q&A is open. We've already seen some great engagement. I'm actively monitoring it, though I will turn my attention now to our really fantastic panel. I am thrilled to introduce three great panelists who are all practitioners sort of within the impact and ESG space. I should qualify it, right? Sort of a disclaimer that they have not all necessarily applied sort of the full IWAF or this version of it, right? It's building on some of the prior work, but they have an extensive background in impact measurement and management that will be helpful to any of those considering doing it within your own organization. So Manon Schenkels is a consultant on integral energy systems at Kiron, which is a company within the Aliander Group. Carlos Ortega works on accounting policy at CaixaBank. And Nalini Terakaswar is head of programs and monitoring and evaluation at the UBS Optimus Foundation. So I am really, really thrilled to have these panelists with me today. And we're just going to sort of jump in with some questions here. Manon, I'd love to start with you first, right? And as you go through your your talk, I'm sure sort of the type of business that Aliander is will come up. But I'd love to ask, what is the most surprising thing that you found out through quantitative impact assessment?
Thanks, Rob, for this question. Thanks for the introduction, and hello, everyone. So indeed, I'll start, I think, with the bit of introduction about Aliander, and then I'll come to the surprises because it's important. So I work at Kiron, part of Aliander. Aliander, it's a network operator in Holland. So we are mainly focused on getting electricity and gas to our clients, and it's a bit broader than that, of course, also looking into the future of the energy transition. I think we've done now like 5 years of impact cases, and we've quite some experience in that in measuring. And I think two things are surprising I wanted to highlight is that we did like a case last year. I think we did a case, so it's a bit technical going now, but so we make connections of the electricity network to our customers, and then we can connect like solar panels or wind farms to get the sustainable energy, renewable energy to our network for everyone to use. And we did a case on the fact that if we would look with our client together to get a connection of solar and wind together on one cable, it's kind of technical. They can be separate, but they also can do together. What will that like earn on impact on the different stakeholders, but also on us and on the environment and everything? And that was like enormous, because we know you can save some materials and you can save some money as well, and you have more sustainable energy connected, but it was a huge true ROI. So therefore we got the talks going in our company, like, did everyone know? And some people said, yeah, we are already like supporting cable pooling. Did I mention the term cable pooling? We call it cable pooling. But it helped a lot to get the conversation going, and that's like the surprises we want to go through to also get the conversation going and to go towards these actions where we can get more value with each other, with the clients as well. That was one. I had one other, but
we might have time for one other, although that one actually does directly lead into the question for Carlos, based on your experience. Well, I'll try to get back to that one, Manon, but segues so perfectly that you've done some IP&L projects, And, you know, I know you sort of talked about it in relation to the banking and sort of reputation, which has, you know, been challenging for a number of years for as an industry segment. So I'd love to hear about how impact measurement and valuation helped your organization.
Thanks, Rob, and good afternoon, everybody. If I may first, and for those of you who do not know it, CaixaBank, as you were mentioning, is a financial group leader in retail banking in Spain and Portugal with more than 20 million customers, and with the ambition of being a benchmark in sustainability, as stated in our 2022-2024 strategic plan, which was presented a few months ago. In this sense, as part of the different value creation initiatives, we've just started this impact journey to measure, manage, and demonstrate impact. And as you were mentioning, we are now taking the first steps of what should be a multi-year project with the goal of obtaining, hopefully, a robust and complete integrated profit and loss account of the group. That being said, and going back to your question, how impact measurement and valuation is helping us, I guess I should start from the basics with some concepts which have been already addressed at this session. This methodology allows to understand our impact, not only on our own organization, the CaixaBank Group, and not only on the financial capital, as it would be the case, for example, of the traditional profit and loss account. And as it's been mentioned, the integrated P&L approach extends the traditional P&L in two ways. First, it looks at all stakeholders. So in this regard, we are identifying how impact is created on our clients, on the 50,000 employees of our group, on society, environment, and on our investors, of course. And second, natural, human, social capitals, for example, are also in scope. So it does not measure only the financial capital. And that's important because for those of us attending this webinar with a finance accounting profile, we are used to deal with documents such as annual reports, management commentaries, etc. This new approach, in my opinion, brings significant added value, and it's a perfect complement to the existing reporting framework. It gives an overview, and it is a faithful way of presenting who we are, how we do things, and how we make a difference as an organization. Final goal for sure is not only on the reporting side, but to incorporate the results of the analysis into management. Of course, we are not there yet, but for sure we would expect additional benefits from it, additional help, once we can integrate impact into decision making.
Wow, that's really, really helpful. And it is also sort of a great transition over to Nelini and your work within the Optimus Foundation trials, right? And what Carlos is talking about, right, a little bit about like the messaging, right, the storytelling. You have a background in development and foundation work, right? And so, you know, broadly, right, that I'll sort of let you choose, but sort of in that theme, right? Like, what is the most surprising thing that you found out through this impact assessment, and how did it help sort of in translating and conveying the value that the Optimus Foundation is bringing either to you or to UBS, right, to others or to your clients as well, who I believe can co-invest in some of it with you.
That's right. That's right. That's right. Thanks, Rob. Thanks for this opportunity. And as you know, we had actually, you know, just for those who don't know, the foundation, we're associated with UBS, which is a financial institution. We focus exclusively on social impact. impact, particularly social and environmental impacts that globally that affect the most vulnerable. And again, here we actually, to your question, what was the most surprising thing? We actually worked, as you mentioned, I have a broad-based experience doing this. It's a growing field. There are lots of frameworks and approaches. Obviously, the impact management project, there's the IRIS standards. And I think we worked last year with the Impact Institute to apply the impact valuation methodology more specifically, because one of the challenges is in the sector is really standardization of outcomes across different sectors. And so what we did, we actually did a pilot. We fund over 300 grants every year. We have over, last year we actually committed over 160 million Swiss francs across projects globally. And so what we said was, let's see how we can apply this to actually standardize outcomes and helps us actually assess impact at a portfolio level. But using investee or a grantee level data. And so we piloted this methodology across 25 different programs covering health, education, and what we call as child protection, and focused really on child labor. So some of really the child labor within supply chains. And what we found were actually 6 things, and this really relates to the methodology of IWAF or actually the valuation monetization. So first, one of the challenges is the standardization. So often when you're working across health, we use the disability adjusted life years so that there's one metric. So coming up with one metric that actually helps reporting on, all of the impacts across all your health programs has been extremely helpful for us. It provided us, obviously there are challenges associated with it, but it gave us food for thought. Second, across education, we used another metric, which again, we work very closely with the Impact Institute to apply the World Bank methodology in the learning adjusted years of schooling. So again here, how do you really represent impact overall across all of the education portfolio? And similarly, in the child protection portfolio, we had some challenges because again, there, the data is actually quite weaker relative to health and education. And here, but we use some of the International Labour Organization data to standardize what are the costs of children actually engage in child labor. So things like, loss of schooling, the reparation costs, and so on. And so what we did with all of this is, some of the learnings is we use data from our suppliers, or what we call as the investees or grantees, different terminologies, like in development you use grantees, you might use investees. And we created reference scenarios using secondary data. And it was really interesting to see how when you monetize these impacts, the monetization is quite a sensitive issue. Particularly when it comes to social impacts, but some of these methodologies are there. And for us, we want to create this impact economy similar to the Impact Economy Foundation. We want to be very much a part of this movement and do that. So that's one, is really helping us understand the process and the data that are required in order to do this. So that was one learning. The second was actually when you compare results, you have to look into account the funding sizes, because sometimes it can range from $1 million to, some programs can be quite large. Also look at the stage of investment, because some of them are in the pilot stage, some of them are really scaling up, because again, how do you interpret information across these different kinds of investments also matter. And then ultimately, context matters, because some of these are being done in humanitarian contexts, in conflict-ridden zones, and some of them may be done in fairly stable environments. And then the quality of data also is quite important. And again, here, all of these are lessons, Rob, that we have taken from this, applying this methodology in saying, how can we really focus on the quality? How can we support our investees? And obviously, it's not aiming for perfection, because, it's better to be roughly right than precisely wrong, as Keynes mentioned. But again, how can we use this information to enable decisions and really move forward, both at an investee level, but also at a foundation level?
That is so helpful to talk about. We've highlighted some of the benefits, right? I'd love to hear, Manon and Nalini, sort of both individually, you've had, there are some challenges, right, for implementing this sort of day one in an organization. And so I'd love to hear your perspectives about those things. And then Carlos, I have a question more accounting focused for you. So Manon, do you want to go first?
Yeah, that's very good. Yeah, of course, sometimes it's difficult. It's quite new, of course, and it's quite valuable to do this, but you have to implement it in the organization. I think what I wanted to say about that, it's scoping, and scoping. Just focus on something, because it's quite broad. When you now I have a conversation in my company with we want to measure the non-financial part and everything, and they're all like, oh wow, okay, how, where, how? Start with one, start somewhere, make it concrete, try to quantitative if that's possible, but make it concrete so that it's like more than gray, because it's easier when we fall back on the financial numbers. It's like black and white, and of course we need to figure out how to get this black and white as well. But focus on something, and then or on one, for example, we focused firstly on natural capital, so the CO2 emissions and materials, for example, because it's a big one for us when we like cables in the ground and we transport energy, and then it comes to mind, so you they get the feeling with it, and you can talk over that first one, and then you can expand to others. I think that's one of my main lessons learned.
Perfect. And Nalini?
Yes, and I would say probably three things. So one is, I think, to Manon's point, I think we started with health and education, mainly for that reason, Manon, because we know that that's where the data is probably richer compared to other areas. And I think we have a growing environment portfolio, and I think that's the first thing, is actually start where, where you believe that there could be some success, where you can actually take the methodology through right from the beginning to the end. And the second, but it's still again, it relates to the second challenge, Rob, is also, the resources that it's required is also quite intensive, because when I say resource is obviously there is a lot of data out there, actually, because, technology has now helped. But actually, how do you really prioritize what data you want, and also some of our investees' capacity also to really work with us on this, because, and so both at our level, but also the investee level, how do you create something that is simple, but not simplistic, but also encourages this kind of transparency about decision making, what we are finding. So the third thing is related to the transparency. Also, one of the challenges is that, ultimately it's on the interpretation of this information. And I found quite interestingly, we all humans want to see what we believe, right? So I think it's really about, how do you incentivize what's not working as well? So what are the findings, and the sensitivity around the findings can be quite something that investees want to, are quite sensitive about, and how it affects their reputation. So really supporting, building the trust, and how we are using it so that we create that economy. To create that economy, we need multiple partnerships. So how do we bring everybody along to really value this as well?
Yeah, that is such a great answer. Nalini, I'm going to move on to Carlos, but there is a question in the Q&A chat about the specific metrics used for measurement of impact of education. So I don't know if you're able to sort of address that there, but I think those are really fair, in my experience, sort of challenges, and great to hear. Carlos, there's a question which I sort of answered a little bit, right, which is a little bit technical, and I'm coming to you because you have an accounting background. Sorry, this was, not the original questions we rehearsed, but the question is, how can these monetized values of impacts be reintegrated into the more classic accounts of an organization, right? And my response was, well, there's a lot of work that's happening with accounting bodies on sort of like the user of information. So maybe, and so direct integration is maybe not a fair question to ask, but what I might say is, how can you contextualize, right, a traditional P&L, right, or a, pro forma project, budget or something like that with these results?
Well, it's a very good question, quite challenging. But first, let me say that it is not fair to compare this methodology, this framework, with accounting or non-financial reporting as up to date. I mean, they've got like non-financial reporting, hundreds of years of experience, and accounting it's been here forever. This is a science in progress, so it's not possible to reach right now the same level of certainty, and there would be for sure a higher degree of judgment and estimations when building possible these accounts. The question, if trying to build an integrated profit and loss account with a decent level of consensus is it's a process that we will have to reach in following months, year, and we are not there yet, to be honest. It's for sure, Rob, this is tricky, and you can complement on this.
Yeah,
but not there yet.
I will say in some of the trials that we've done, right, as sometimes, right, sometimes there's something that one example that comes to mind is an organization wanted to do a big retooling of their delivery vehicle fleet, right, to move all electric, right, or move away from diesel to something, sort of cleaner. And it was a huge cash outflow, right? You know what I mean? And so the immediate look was, no, this can't happen, right? But the decision changed when they looked at sort of the monetized value of the reduced GHG emissions, right? The reduced fine particulate matter, et cetera, right? That was some way in which they were able to explain to investors. On the other side, an organization might be thinking about, wow, this is a great opportunity. Look at this big P&L, right? The big potential market share. This is another example that's coming to mind without sharing confidential information, right? And then they sort of had they turned their traditional risk assessment, right? And they monetized it, right? Around sort of impacts to communities, et cetera. And all of a sudden that sort of abstract risk assessment, even with the different margins of error, right? That abstract risk assessment all of a sudden became really real, right? Oh my gosh, wow. These sort of potential profits didn't look so big in context of sort of the risk adjusted return. So I don't know if you have anything to add there or not, but we have for Rainier. So Rainier, if we can put you on the spotlight. Could you elaborate on the difference between applying the methodology to financial institutions where the majority of their impact is in loans and investments? Is this included, and is this work the same, and do you report this separately?
Thanks, Rob. That's a very interesting question. I'd say at financial institutions, we can do two things. Either we can make the impact weighted accounts of them as an institution, or we can help them with certain investments. And in the second case, we would directly look at the investee, and it's basically everything I told from the perspective of the investee. I think the question is focusing on the first half. So if I want to make the impact weighted accounts of a financial institution. And in that case, we would basically make two models. One is the model of their own operation. I think Carlos said that you have 5,000 employees. So that's not a small organization. That is significant impact on your employees. It's also rather significant impact on the direct environmental effects on having all those buildings and all the transportation, etc. So that's the first model, you as a own organization. And then secondly, we would make the model of your investees and your loanees. And there we would basically take them as the central organization. Or we can either do that if you have a couple of like the very, very largest, we can do that with an explicit model. If you are lending as many institutions to thousands or hundreds of thousands of organizations, then we often use statistical models like environmentally and socially extended input-output modeling to make a good model. And then we have the model of your own organization. We have the model of everything they lend to and invest in. And if we combine that and if we attribute the impacts in the right way, we can make the summarized impact for the financial institution. And on our website, for instance, you can find examples of how we did that with ABN AMRO Bank. Those are now public. And we are also doing this with, for instance, with Caixa Bank, with Carlos. And I expect those to become public also relatively soon.
Yeah. Well, that brings us to the end of our panelists. I wish we had more time because you all have amazing experiences and you know, different expertise and just tips to bear. But thank you all so much for joining us today, and thank you to everybody on the call. It's really amazing in these very, very busy days, to have over 100 and well over 100 people for an hour call. I know people are in the Northern Hemisphere getting children back to school now, and getting back after the summer holidays, and so it's a busy time. We thank you all so very much. I will remind you that the public consultation of the IWAF is extended through September 30th. We will make sure to share the link as a follow-up to the public consultation page. Everybody is invited to respond to it. The response can be done partially, fully, written, and if you don't want to write, you can just email somebody on the team and they will take your response orally. We really just want, if you answer one question, that would be fantastic, right? To do it, because somebody asked a question of, do we have data tools available yet? Right? The answer is no. They are scope. We are thinking about these, but we want to make sure we get the foundation right. And the way we get the foundation right is by public consultation, stakeholder engagement, and incorporating that. And so if you can, take a look, take a little bit of time through the end of September, that would be so fantastic. It's been my honor to moderate this session with our esteemed guest panelists. Thank you all for sharing your real lived experience applying this. Thank you for continuing to push this within organizations, which we all know is not always an easy task. And we will let you go right on time here. Anything else I missed, Rainier? Werner? Good.
No, I think that's it. The only thing I would like to do is thank you for the great moderation. And I would like to also stress, please respond to the public consultation and help with rolling out the impact-weighted accounts framework also in businesses after we've launched it. So reach out to us and let's work together on the impact economy. Thank you very much.